Welcome to this explainer. Look, if you've ever run a scaling business, you absolutely know the dread of hitting that regulatory wall. The one where making more money actually means getting hit with massive taxes and suffocating audits. It's the worst, right? Well, today we're unpacking how emerging economies, places like Tajikistan, are engineering a totally genius way out of this trap. They're actually replacing punitive, enforcement-heavy tax collection with a revolutionary 3% digital architecture. It's a system that offers literally infinite scaling capacity. But there is one absolute condition: complete digital transparency. Let's get into it.
So here is a quick look at our agenda for today. We're going to cover the revenue cap bottleneck, the new digital fiscal bargain, how states are crowdsourcing compliance via cashback, and finally, strategic enterprise integration. All right, starting off with Section 1, the revenue cap bottleneck, the regulatory doom of simplified regimes. Think about the traditional way of taxing retail and consumer services. Typically, the state sets these strict revenue ceilings, mostly because tracking cash in hand is just an absolute administrative nightmare. But you know what that does? It forces this really perverse choice on business owners right as they approach that cap. You basically either have to halt your commercial growth entirely, literally capping your own success, or you illegally fragment your business, setting up this whole tangled web of shell entities just to fly under the radar. It's an incredibly stressful, high-risk game to play. But this modern digital architecture, it flips the whole thing on its head. By utilizing automated POS APIs and consumer QR codes, that ceiling completely vanishes. It replaces all of that statutory friction with a highly competitive 3% flat rate, which means businesses can just focus on getting as big as they want without that constant nagging anxiety of a regulatory crackdown. Moving right along to Section 2, the digital fiscal bargain, removing the glass ceiling. So this whole shift is really built on a carefully calculated structural compromise. On one side, the state makes a massive concession. They drop those arbitrary gross revenue caps for qualifying consumer businesses, they lower your effective tax burden to a flat 3%, and they totally scrap all that complex, bureaucratic expense verification, right? But in exchange, the business makes a strict, non-negotiable promise. Physical cash is dead. You have to mandate 100% digital fiscalization. Every single commercial transaction has to route through electronic POS terminals, QR payment gateways, or automated online cash registers. You'll often hear these called KKMs in the region. And all of it has to link directly to the state's cloud infrastructure via API. And what you get is a beautifully simple formula. Your digital tax liability is quite literally just your verified electronic turnover multiplied by that 3% statutory digital rate. Honestly, if you're a financial architect or a business owner, this is an absolute breath of fresh air. You know exactly what you owe in real time. There's zero guesswork, absolutely no messy end-of-year audits where you're haggling over allowable deductions, and definitely no need to risk everything on illegal shell entities. It takes taxation from being this massive, unpredictable burden and turns it into a totally predictable, straightforward line item. So what does this actually mean in practice? It means a retail network can finally operate as one single, fully transparent legal entity. You can scale your consumer turnover from 1 million all the way up to 100 million TJS. That's the local Tajikistani Somoni currency, by the way. And you can do the whole thing completely above board. No triggering regulatory penalties, no scrambling in the dark to hide your growth. That glass ceiling, it is well and truly gone. Okay, let's look at Section 3, Crowdsourced Compliance via Cashback. The consumer as tax inspector. Historically, enforcing taxes meant sending out legions of field auditors or mystery shoppers just trying to catch unrecorded cash sales. It's a system that is incredibly labor-intensive and, honestly, pretty ripe for corruption. But this new model, it does something totally brilliant. It aligns the state's interests directly with the final retail consumer. It essentially transforms your everyday shopper into a highly motivated, decentralized tax inspector. It's kind of like crowdsourcing the IRS, right down to the person buying a cup of coffee. Let's break down how these cashback mechanics actually play out in the real world. Step 1. A customer buys something, and the business issues an electronic fiscal receipt embedded with a cryptographic QR code. Step 2. The customer whips out their phone, opens their national banking or tax app, and scans that code. And Step 3. The state instantly deposits a statutory percentage of that purchase right back into the consumer's digital wallet as cashback. This fundamentally rewires the psychology at the point of sale. Think about it. If a cashier tries to hide revenue by not giving out a receipt, or maybe asks for an off-the-books cash payment, the consumer is going to actively push back. Why? Because you are directly messing with their personal financial reward. Trying to hide revenue becomes practically impossible because you're risking alienating a customer base that absolutely demands their cash back. And that brings us to Section 4, Strategic Enterprise Integration, architecting resilience for the C-suite. Listen, for the executives out there, dodging taxes under this system just doesn't make economic sense anymore. The actual financial cost of compliance is now substantially lower than the legal, operational, and reputational nightmares of evasion. But to really thrive here, the C-suite has to make some specific structural adjustments. First up, you have to execute prime cost integration, baking that 3% tax directly into your initial unit economics and retail pricing. Stop treating it as this painful year-end administrative deduction. It needs to be integrated upfront. Next, you have to automate. By implementing ERP and POS API fiscalization using platforms like Odoo ERP, for example, you completely eliminate manual data entry and historical bookkeeping. Every single sale is instantly fiscalized, automatically reconciled with bank deposits, and securely logged in the general ledger in real time. This is a total game changer because it frees up your finance team to actually focus on growth strategy rather than getting bogged down in basic compliance headaches. Ultimately, when you combine that low, flat statutory rate with automated platforms and API fiscalization, your entire operational mindset shifts. As the quote goes, in the modern Central Asian economy, transparency is no longer a liability. It is an optimized operational workflow that unlocks unlimited scaling capacity. It stops being this regulatory trap you fear and instead transforms into your primary growth engine. So I'll leave you with this to chew on. Are your legacy manual tax strategies currently bottlenecking your enterprise's potential for infinite digital scale? Are you still playing by those old rules of cash monitoring and revenue caps? Or are you ready to finally embrace the digital fiscal bargain? Take a minute to think about how these modern digital architectures could completely redefine the ceiling of your own business. Thanks for joining me for this explainer.